Hello, everybody. Welcome back to another edition of the NoBondsCast here at Beck Bode. I'm here with the Bode, Jim Bode, back for another episode here. Jim, I think we started doing this or revamping the NoBondsCast about 4 or 5 weeks ago, right?
Yeah, and I think the feedback we're getting is better and better. So we're even getting better at doing these.
Well, let's not go that far, but baby steps here.
Maybe
Baby steps.
our guests are getting better, and
Yeah.
that's put a little pressure here on Vinny.
Yeah, that's it. Guests are definitely getting better. Our approach here has been obviously first and foremost to address some of the things, some of the issues that are going on in the world and trying to make sense of those for the benefit of our clients, of our viewers, but also to highlight some of the great people that we have at Beck Bode. Unfortunately, we couldn't find anybody for today, so Vinny's here. But he'll be on for a few minutes here. No, all kidding aside, Vinny Savio. Vinny's been with the firm out of our Dedham office, our headquarters office, a good 10, 11 years, Vinny. Is that right?
Just over 10 years. I'm waiting for my 10-year gold plaque in the mail still.
Yeah, yeah, it's in production. Yeah, so Vinny's been with us for 10 years, a little bit more, and works out of our Dedham office. He's a financial advisor, also is our head of client advisory. And so actually, well, instead of me, Vinny, why don't you kind of tell everybody that's listening a little bit about what your role is all about here?
Well, I've had the unique opportunity of starting from the bottom, really. I came on as an intern a decade ago and came up as an associate, a service person, a trader, an advisor. Now get the opportunity to sit on leadership and work with the great staff you guys have put together and help the advisory staff work with their clients and communicate directly to the managing partners. So it's been a journey, but it's been a great one.
A jack of all trades.
Utility player, as I like it when Jim calls me.
That's right, the utility player. That's good. That's it. Always there to step in, whether it's operationally, which, and as Vinny mentioned, from the very get-go, when we were a much, much smaller firm, we had left Merrill Lynch back in early 2013, opened up Beck Bode, our firm, and it was just a few of us. And Vinny joined and was able to step into a role where, well, I would say somewhat undefined, right? Just basically a utility player jumping on whatever task was needed for that particular day. And his position today, it has been for a while, is head of advisory. So not only taking good care of our clients, but also offering a significant amount of support for all of the people within Beck Bode that work for Beck Bode, and being a tremendous value add there. So excited, Vinny, to have you aboard today with me and Jim. Why don't we jump right into it, Jim? And one of the things that you and I talked about recently was that when we started or revamped this podcast, the idea was just to make sure that we have a consistent line of communication out with our clients, people listening about what's going on in the world, our thoughts on financial planning and investing and such. It just so happened that right around the time that we started, new administration in place, a lot of volatility in the markets with all the tariff talk. And here we are, 4 or 5 episodes later, and we're seeing a lot of volatility and such, which, again, as we'll talk about today, nothing out of the ordinary, but there is an element, right, of, well, we don't want to have a podcast every couple of weeks and the message to be exactly the same, right? Boring, stay the course, all these different things, which, of course, is very valid and viable. But, Vinny's going to talk about some other stuff today, but, I just wanted to reflect on our conversation about, hey, we may sound like a broken record, right? But it's very important information to get out there, especially during times when it's a little trying on your anxiety.
Yeah, and what's great is I think you mentioned this is our 4th or 5th episode right now, and every time market volatility has come up a little bit differently, right? Similar story, but hearing it from one of our panelists or guests might say it's slightly different. That might resonate with some of our listeners here today.
Yeah.
And I think that's what's great about having the company that we do is there's a consistent message, but everyone might say it a little bit differently. And as much as market volatility has been in the news, I think kind of putting it into context today with Vinny is going to be really, really interesting when we look at the historical context of market volatility.
Sure.
What's great with Vinny is he's a lot of times the first point of contact for a lot of our advisors, and a lot of them go to Vinny right away when they're having questions or consistent questions from some of the clients. And I think, Vinny, you said that market volatility right now is definitely up there with one of the largest questions that's coming from our staff right now.
Oh, for sure. And, with our own clients too. I mean, how many calls are we getting on a, weekly basis of these 3% pullbacks, 2% pullbacks, the uncertainty that's out there in the administration, as you pointed out, but also the news on a daily basis. And I find it tremendously frustrating at times because we have such a short memory for all the things that have happened in the past. And one of the things I was excited to talk about today is actually the frequency of it all and some of the stuff that we've all forgotten about, but were the big talk items just a handful of years ago. And we always hear we need to do this, or we need to get out of the market here. But we always want to reiterate to not only our clients, but our staff and ourselves is, we have a process in place, and these aren't out of the ordinary. And I think volatility, corrections, even the warnings of recessions, get a bad rap, and people forget how common it truly can be.
Yeah. There's that phrase, right? That unfortunately we can hear a lot when these things come up, and that's the four words: this time is different. Right. And because it can feel that way, right? I mean, these market corrections, these bear markets, these things that are happening in our world that do or do not ultimately affect the economy, but with each individual that we can work with, it potentially, gives them a feeling of, well, we've never faced something like this before, or this is a different flavor of something that I'm not so sure that the world can figure out. Something that we face quite a bit, right?
Absolutely.
Yeah.
And even the opportunity that it really presents to everyone on this call, right? And the good that can come out of it, and not trying to, as the title implies, not trying to time the market itself.
Yeah, I think you said it really well right there, guys. And there's something different, or it feels different every time the market is volatile. But when we look at historically, is with all the different things that might cause these ups and downs, the markets, the economy has always come out stronger. Every single time it's come out better and stronger than when it was before it started. And I think that's the message that we keep wanting to share with as many people as possible is that it might be uncomfortable, but we know how this is going to end. And it's going to end that we're going to be in a better place.
Yeah. That's we use the term around here, for those of you watching that don't know, the term is relentless. And that's something that, well, it means a lot of things with us and how we operate our firm. But when it comes to the market, when it comes to investing, what Jim said there is a perfect example. The long-term increase of the markets as a whole is relentless. Doesn't go down. We've got over the last 100 years, right, of data that we have. With all these things that Vinny was alluding to just a moment ago, the markets have chugged along at a really, really healthy average rate of return over that time. And that's one of the things, Jim, when you're talking, it kind of reminds me of that we have to keep reminding, we have to keep reminding ourselves in some cases, right, that, when we go through days when the Dow drops 1,000 points or whatever it is, or some function of that as a percentage, it's really important to consistently remind everybody that we work with about how relentless that push forward actually is in the economy.
Yeah. And again, for those who are listening, let's define it for a second. What is a correction? A correction, by the definition that's out there, is a 10% drop from the market's highest peak at that time. And how often are they? Ben, in your experience, when we're sitting down with new clients, because I know we like to be so forthcoming with this information, and I find it tremendously empowering that we set expectations this way. How frequent are these 10% or greater pullbacks happening?
I mean, from a frequency standpoint, when you look over the years, now it doesn't happen, it's an average, but every about year and a half, a little bit less than that actually, every 14 or 15 months on average, we go through what you're defining there as a correction, which is a drop from the high in the market of at least 10%. So you think about that, and you, I know as well as I do, we all like to quantify things in dollar terms, because we can talk about percentages all day and they don't really mean anything. But when you start looking at the actual account, someone's account, if you're listening right now and you're thinking, oh, I've got $1 million in my account, a very normal correction that happens on average every year and a half or so means that account, your account, will probably drop at least 10% temporarily, but it's going to drop. So quantifying that in dollar terms, that's going to drift below 900,000. It's going to be at least a $100,000 decline. Again, not going to last historically very long and move its way up, but that's how we like to do things. We like to quantify things in dollar terms with the hopes that doing that consistently over time, it sets in that these are so damn regular that, what, if it means not opening your statements or not logging into your account to look at what the value is, since you saw something on TV that said, hey, the markets are in a really, really tough spot right now, maybe that's the answer.
Sure. And for me, I'm a pretty visual person here, and I know we put together something to reference so everybody could follow along. Can we share that now?
I think so. Producer Jack in the background. I think he's going to throw something up on the screen for us. Ooh, here we go. Look at this. All right. I think we can. Awesome. Look at this. All right. Tell me, Vinny, what does this chart mean to you?
So it's a list of all the negative stuff that happened around the world where it triggered some sort of reaction in the market, typically from a negative side effect. It's not all of them, and it's not signifying just a correction around, but it's something that happened, had a news headline, and the market reacted and pulled back in a substantial way. And so one of the most impactful things as I'm looking across this is this only goes back to 95, right?
So we're talking 30 years.
Right. So we're looking at over 37 events that are plotted across this short timeline. And I think as some people might be looking around, there's some obvious big ones that are out there, like September 11th, or COVID, obviously, that's going to jump up on either end of these things. But there's some other stuff that may have kind of fell out of memory. Like there's some that I know that you guys might want to talk about specifically, but one of the ones that stood out to me where I actually want to take a look was right around 2018 there, you'll see the US-China trade war. So kind of an interesting topic where we look at what's in the news headlines today and what was just 7 years ago. So wanting to dig a little bit in on that because you have the same president who's in office as was at that time. And I truthfully didn't remember a lot of the details here. And so I was just kind of interested in really taking a look at what this event did. Okay. Because I think it's relatable today for those of us who are going through what we are. So this event took place in a similar way where there were tariffs imposed both back and forth. The market reacted in a negative way and had a significant pullback and ended the year overall down 6%, which was headlined in a couple different ways. And CNBC had it from everything of the worst year of the market since the '08 financial collapse. It had the single biggest point drop day ever. Now, you got to read into that a little bit. But as you dug into these things, it was interesting to see how it all played out. We talked about corrections here and how they're short-lived. And when we talk about the correction, when it happened at the peak of the market, then we follow it to the bottom or the trough of the market, and then when it starts to recover. So from the top to the bottom lasted approximately 65 trading days. Okay. Then from the trough back to the point of the old peak was an additional 75 trading days. So we're talking about months of anxiety.
Yep, a couple months.
Right. And the market at the end of 2018 was down about 6%. And then by the end of 2019 was up approximately 30%. So
pretty nuts.
Going through all that uncomfortability to tie it out of percentages for a second, had you invested on the first day of 2018 with $1 million, not panicked, sat through everything, came back on the other side, and was invested in the equity market, it was a return around 68.9%. So meaning your $1 million is now 1.7 million approximate today.
That's amazing. That really is amazing when you put it in context like that. And if I remember correctly, it was late October where the markets really started to dive in 2018, where that trade war, tariff talk with China really started to heat up. I think it lasted, well, you said 65 trading days, right? So it lasted, I think it was Christmas Eve, where it was a shortened trading day. I think that was either the last day or the first up day that we really saw from the bottom. And what's interesting to me about that is that with all the great figures that you gave during that short time period, even though technically it wasn't a bear market, which I should probably define here as we defined a correction, a bear market, if a correction is a decline of 10% from a high, a bear market is a decline of 20% or more from a high. Now, technically, corrections in bear markets are measured based on closing prices. So this particular downturn in late 2018 was not technically a bear market. However, intraday, the day that it hit its lowest lows before it turned back up, it actually did exceed a decline of greater than 20%. But by the end of the day, it had risen back up. So we count it here. We count that as another bear market, as in close enough, so to speak. But it's really remarkable that, the figures you're giving here in just such a relatively short time period where you had, like you said, Vinny, months to worry about things, wall of worry, to worry about things. But then you stretched that out to just, what was the time period? A couple of years? And
no, that's till today. So the interesting part, if you look at that, is look at all the other dots that we've gone through throughout that time where we had opportunities to make mistakes along the way and get out. And I'm not saying that, the same is happening in this trade war and they could expect, similar returns or whatnot, but the feelings are there and we've experienced them in the past. Who knows how long this rides out, whether it's shorter, whether it's longer. But I think, as everybody can tell, the recovery can be dynamic.
Yeah. And the financial media doesn't help, right? I mean, I think you alluded to it a few minutes ago. When we go through just one example of many that we have on the screen right now, I mean, what do we think the financial media is talking about? When you turn CNBC on, you turn Bloomberg on, and you turn the news on for that matter. you know, they're not giving you great things to look forward to, right? They're talking about worst case scenarios, right?
Right.
Yeah.
Absolutely. Absolutely. And then it puts the pressure on not only the individual investors, but advisors, their teams of, what do we do? How should we move? Do we have to change something here? And Jim, through conversation, and you raised this question, which is always a great one. It's like, did we change our process, or do you change your process or your outlook with your clients going through these times?
Yeah, as I look at this chart, Ben, since we started working together, there's 23 events on this chart since 2009. And I will tell you, during those 23 events, our investment strategy hasn't changed. What we've been doing for our clients has stayed very, very disciplined and very consistent. And we do get asked all the time is, okay, what are you guys going to do differently this time? Or what has to change? And reality is nothing has to change. The process is proven to work through all the ups and downs and the volatility through any market. What does change, though, is the individual holdings that we have for our clients. And based on the research that we have, we're going to go in there every 6 weeks on the growth side, and we're going to see what's happening in the world, and we're going to look at our research and their future earnings. And when those future earnings change, we're going to change with it, and we're going to put different holdings in our client's portfolio. So the reality is the strategy stays the same. What we've been doing stays the same. The individual holdings will adjust based on what's happening in the world around us. But I found it fascinating that since 2009, Ben, when we started working together, there's been 23 of the little dots or crises, as they would call them on this. And we've powered through this in a really, really positive way.
Yeah. Yeah. It's, when I hear you talk about that, it's in my mind comes up, it's like those questions that we get about what are you going to do differently? That implies something of maybe market timing or trying to predict what's going to happen in the economy in the short term. And those are just things that we don't do, plain and simple. And I mean, we're in good company because, folks like Warren Buffett, who most folks have heard of, and Peter Lynch, legendary mutual fund manager, investment manager, long time at Fidelity, and many, many other extremely successful billionaire investors will say the same thing. When it comes to investing, trying to predict what the economy is going to do in the short term, or trying to time your entry or exit, right? That's another kind of theme, when we get that question, right? Is that, it's not quite the right time to invest. Is it, Jim? Is it, Vinny? Or I don't want to lose money because of what's going on in the markets today. Like you said, we stay consistent. Our policy is to invest throughout any and all of these market declines that we see, which is really what we, as great as we and as passionate as we are about the strategies that we run, as Jim, you said, the focusing on research, the research is looking forward to giving us information about where the profits of these companies that we're looking at, and how those profits are expected to rise or fall is the name of the game for us. But what's not the name of the game is jumping in and jumping out at different times based upon what's going on in the world, which actually, as we talk about this, brings up another question about what we do really before we even get to the investment side with a lot of our clients, which is the plan. Vinny, can you talk a little bit about how we approach that, or how our approach in planning kind of drives the way through these issues and these crises that we see in the markets?
Yeah, so I think first things first, it's to tie off of what you just both talked about is, is it a good time to invest? Should I put my money to work? Well, first thing you should do is have a goal of what the money you're talking about is being utilized for. Okay, once you have your goal established, you're able to then set a plan in place. Once you build out a plan, you now have a target of what you need to get to, what you need to achieve, and what you can expect along the way. Thirdly, you implement a strategy on how to execute that plan. And it's all going to tie back to your original goals. And I'll say, based on that chart, the most important piece is honestly really a fourth step here, but it's patience. It's patience by us as an advisory team, by the investor who has to sit through it, watching their money go up and down. But it really comes back to, what are you trying to accomplish here? So is it a good time to invest? Well, none of us know if it's the perfect day, but if you're sitting on money on the sidelines and you're waiting, I think a couple things you have to ask yourself really is, again, what is it for? But do I have a fallback account in the short term? Are these proceeds going to be used to buy a new home in the next couple of years? Do a home renovation that you and your family haven't, been putting off but can't wait to do? Or is it to do something else that's going to require some short-term liquidity? The answer is no. The answer is no. Don't put it in the market. There's other ways that you can save that principal. We'll work with you to that, but that's about defining that goal. When you start to look 3, 5+ years out, as that chart showed us, it is a good time to invest. It's a good time to establish a plan. It's a good time to execute on a strategy. It's a good time to have a discussion about what you can expect over that time.
Absolutely. Yeah. I mean, time solves everything, right? That's what the 100 years of data has shown us, right? And, I think that's so well said about the path that successful investors take. The characteristic of a successful investor doesn't start with, what am I going to invest in? It starts with, as you said, hey, what am I investing for? What is this wealth that I want to eventually accumulate going to ultimately produce for me and my family, by and large, right? And then it comes to, I'll maybe say just a tad differently, but meaning the same thing is, okay, well, what's the blueprint to get there? Right? Okay, so we've identified what's most important. What's next? And then and only then do we look at the investment strategy, which again, we're very passionate. Our investment strategies have stood the test of time. They were created back in the early 70s, but sort of meaningless if you don't have the first two things figured out. And that's something, Jim, I mean, we've preached for quite a while.
Yeah, and we've gotten really good at it too. Well, we can compliment ourselves for the way that our business has evolved and really focusing on the plan and focusing on the process to get to actually how we're going to invest the funds has made all the difference for our clients. And now our job is to pull up those plans again when we are seeing the volatility and reminding our clients is this is what we're trying to accomplish. And Vinny hit a very big word that I use all the time now is patience. Patience wins the long game. And that's what we're all after. And starting with that plan, starting with the discipline is going to help us stay ahead of the game and make sure that our clients see quality long-term results with what they're trying to accomplish in their lives.
So in hearing that though, not though, but like there is a legitimate question that does come up, particularly with clients that are retired or close to retirement. And Vinny, maybe you can talk a little bit about this in the sense of like, look, I'm retired now. I don't have the income coming in from a job. I'm relying on my portfolio to produce what I need to live for the rest of my life. For example, my initial or primary retirement goal. I also have other goals of supporting my family, charitable. I'm worried that, hey, what if this tariff business continues or whatever the different flavor is about what's coming next? And there's always something that's coming next. What's one of the things that we do within the planning process as clients are moving towards retirement that can sort of be a buffer to, these events that we see, not often, but these really big drawdowns in the market? How do we address that?
Yeah, and it's a great question. It's what I started to allude to a little bit there, where it's having a amount of cash set aside covering your specific living needs. And the idea behind it is putting that in a money market type style account, making sure you have access to the principal. So when and if the market does start to draw down, which is inevitable, we've talked about it a bunch, we aren't selling your positions now at a loss, but instead we're enduring the volatility during that time, letting the strategy work the way that it needs to. So when it does recover, we're on the good page where we didn't settle those losses. And now we're taking some of the money out of that cash bucket and supplementing your needs. So the planning process is so important there, especially into retirement. So that way, you know that you have those funds set aside and accessible, and your team can get them to you very quickly. And the patience part really comes back to allow the market to exceed. And then when the market is back, we'll start dipping back into the stocks that are producing the gains and replenish that cash bucket, because it's going to happen again.
Yeah. Yeah. So while nothing's perfect, it's a part of the financial plan, right? That allows you as an investor to have, if only, not to imply that any correction or bear market or such is comfortable to go through, but perhaps an amount of comfort to know that, hey, I have a certain amount of money set aside that represents, whether it's 12 months or 18 months or 24 months of my living expenses set aside, and if only for an emotional comfort, right? To know that that money is set aside if and when, we're not implying that you necessarily have to, are going to have to use it, but it's there to provide that safety net, that comfort.
Absolutely. And that's why all of you are unique in that way, where you might have other streams of income. And that's why planning is so important for us to have a really good understanding. So that amount is the correct amount for you when and if it comes up.
Yeah. Fantastic. Great conversation today. I really, enjoyed, as my phone keeps going off here, I really enjoyed, these really, what are interesting and really important parts of what we would call the financial planning process, right? Is as really understanding what drives the decisions that we make, what drives the decisions in the portfolio, in the investment strategy, and what really are the characteristics of having great success over the long term. It was really great to get, Vinny, your thoughts on this, since, as Jim had mentioned earlier in the podcast, about not only do you work directly with clients, but you're also, in your position as chief of advisory, you're supporting all of our financial advisors with their efforts, with their clients as well. So you're getting a pretty decent cross section of everything across the firm, which I think is really helpful for the viewers today to really hear your perspective. Jim, Vinny, any parting thoughts before we head out for today?
No, I'll just add that, yes, we did talk about market volatility again, but hopefully you saw it in a different fashion, with kind of looking at the historics. And I find it eye-opening that 23 events, Ben, that have happened since we've been working together, and not even really realizing that they're going on now, since they're so far in the past. And I don't know if it's a year, I don't know if it's in 6 months, but this too will pass. This too will pass.
Yeah.
Vinny, any thoughts before we head out?
No, just a big thank you for you guys including me. Obviously it's something that's on all of our minds. So happy I could share anything with the group, and thanks again.
Yeah, no, I appreciate you coming on. Yeah, one thought is that, in digesting everything we talked about today, is that successful investing really has to do with resilience. It really has to do with not only understanding what you're investing for and why, but having a partner in the equation, financial advisors, a team like us that all work together to help guide you along the way. It's not easy. It's definitely not easy to go through these times that we're going through now, that we will go through, as Vinny, you pointed out, You know, every year and a half, on average, we go through a correction. Every 5 or so years, we go through a little bit tougher of an environment, you know, a bear market. We don't have the solve for avoiding those, as we talked about. We do have the equation for substantial long-term success, and investing throughout any and all of these market declines is the answer for that. And we're here to help in any way, shape, or form that we can. So I appreciate all the insight, Vinny. Jim, as always, great to engage in the discussion with you. And for everybody watching, thank you so much for tuning in, and we'll see you next time.
Thanks,
later.
everyone.
Thank you.